Hello, this is Julius from Basic Financials. Today I'm going to revisit a subject that I've talked about before, and that is pension contributions. Now, as I say, I've talked about these before. I'm not trying to advise people that they should be putting money into pension contributions or that they shouldn't. Or anything to do with investment, because I'm not qualified to do that. But what I do know about is the tax benefits of investing in a pension scheme, and now this particularly applies if you're a 40% taxpayer or additional rate taxpayer, or 45%. It also may well apply if you've got child benefit coming in. But it also applies just generally if you're not a taxpayer even, or if you're a basic rate taxpayer. And the reason is because if you put in £800 into your pension fund, then the government will add £200, so you'll end up with £1,000 in your pension fund. So straight away you can see that you're getting a benefit just by putting something in. The government are adding to it. Effectively, you're putting a contribution in of £800, and the government are adding 25% of what you pay to make it what they call a gross contribution of £1,000. So the basic rate tax relief is actually 20%, i.e. £200 of the £1,000 gross. But you just pay the 800 net. Now, the reason why I'm revisiting this is because of something suddenly struck me, which I hadn't particularly thought about. In one of my videos previously, I mentioned that if you're in an auto-enrolment pension scheme, for example, there are different ways that your pension might be deducted from your pay and paid over to your pension scheme. And this isn't just auto-enrolment. There are other forms of pension. There are company pension schemes that you might have joined, which are not to do with auto-enrolment. This normally applies to the bigger employers, but you may well be involved in one of those schemes. Now, if you're in an auto-enrolment, one of the ways that you might see your pension being deducted is by you being deducted at the end of your payslip. Basically after you've paid your tax and national insurance, you then get deducted at 80% of the amount of your contribution. So normally you would be paying 5% of your pay, but not quite 5% of your pay, because it's between certain limits, so it might not be actually 5%. You need to know what those limits are, which I'm not going to go into here. But you wouldn't actually see that 5% coming out. You would see 80% of that 5% coming out, because you're getting basic rate tax relief at source. And then what you pay goes over to the pension fund, and the pension fund will claim the 20% back from the government. That's one way of it working. Now, if that's the case, and you're a higher rate taxpayer, then you're due to extra relief. You're due another 20% tax relief, because you've only had that 20% tax relief at source. So you're actually due some more tax off your pay. And the way you might tell HMRC about that, the tax office, is either to give them a call or to prepare a tax return and claim the relief. Now, in the previous video, I said that the other way is that your pension contribution might be deducted from your gross pay, and then your tax is worked out afterwards. In which case, I said, in that case, you'll get tax relief at source, and you'll get your full tax relief if you're a 40% taxpayer. For example, if you're getting a salary, if you're lucky enough to get a salary of £70,000, and your gross contribution is £10,000, that's quite a bit, but there might be that. Then you would have your tax worked out on £60,000. So you would have got your full 40% tax relief through the way it's been done. Now, it's sort of struck me that it's possible you might have a salary of say £50,000, and then you'll have your your contribution deducted, but because your salary is under the higher rate limit, you would only have 20% tax deducted, 20% tax relief, because your gross contribution would come off your gross salary, but your gross salary is only being taxed at 20%. Now, if you've got other income, so say you've got a dividend somewhere from some source, or rental income that takes you into higher rate, you won't have got all the tax relief that you're due still. So if you're not a higher rate taxpayer on your salary, but when you look at your total income because of other sources of income you've got, and it takes you into higher rate, then you also need to claim some extra tax relief because you haven't had it all. So anyway, that suddenly struck me. It seems obvious when you say it, but anyway, that's something to keep in mind. So make sure you're getting your full tax relief on the pension contributions. I'm going to leave it at that. It's something to think about. And yeah, thanks very much for listening. If you could like and subscribe as usual, and I'll see you again for another video soon.